welcome. Thank you for another episode of the Black Wealth Experience podcast. And today I have Rashad Younger here today, who is going to be our special guest. And so when we think about all the different things on homeownership, and we think about the wealth and generational wealth and personal wealth, and we realize that probably the number one stair step to personal wealth and generational wealth is homeownership. And that's here in America. And, as we think about stuff, Rashad, of being able to do that. And so we are having a Black Wealth Housing Summit. It's going to happen on June 19th. It's going to be at Cross Purpose, which is on the corner of Martin Luther King and Colorado. So if you lived in Colorado at any time, you know where Martin Luther King in Colorado is. Yep. There's an AME church there, and it shares a parking lot with the AME church. So you'll be able to find it 5:30, 7:30. And we're going to put together a real estate agent with a loan officer, with a credit repair person, with an insurance person like yourself, and with financial planning, so that we can kind of put a plan together for anybody who's interested in getting a home. And so there's a lot of people, Rashad, that believe that they can't get a home. They have this myth that you have to have 20% down. Or, I go into these apartment complexes all the time. Like yesterday I was in one, and a guy pulled up in a Land Rover. I know it's an $80,000 car. And I know he's wiping snow off of it in the winter, right? Because he doesn't have a garage. But at the same time, I just kind of said, have you ever thought about, getting a home? And he's like, I don't think I can get one. I don't have a down payment. And right there, it let me know, somebody can afford, an $80,000 car. They probably can afford a house. They just don't know how to do it. They don't know that process to be able to do it. And so we're having that, that's going to be like one of many, seminars and workshops and things that we're going to put together for folks. But we want people to get into homes. The theme is usually, whose mortgage are you paying? You're either paying yours or not. And if you're paying, $2,000 a month in an apartment, in a year, that's $24,000. If you stay in that apartment for 10 years, that's $240,000. You paid for that unit, because 10 years ago, that unit didn't cost $240,000. Or if it's a house, that maybe a $500,000 house, you paid half of the man's house by you living there for 10 years, which is okay. I'm not saying renting is bad, but I'm just saying if you have another alternative and you have the ability to own a home, then that's something you're absolutely going to want to do. Yeah. So, we have Rashad here. This is exciting that we have you here today, because I know you're going to talk about insurance. I know you're going to talk about finances and what goes into the thought process of homeownership. So before you get started, getting into the nitty gritty, why don't you just kind of tell people, how do they get a hold of you? Email address, website, whatever it is, how to get a hold of you. And then maybe a little bit of story. How did you get into this particular line of work? What made you excited about helping our community in this respect? So definitely love to hear.
Rashad Younger. I'm the owner and founder of Younger Enterprise Services. We provide financial services as well as insurance. You can get a hold of me. My cell phone number is 303-941-3917. That number again is 303-941-3917. You can also visit my website, which is youngerservices.com. Feel free to, browse around the website, get some information, as well as you can also contact me there. The reason why I stepped into this space originally was, I got out of college, got my degree in journalism, thought I was going to go in that path, working for Denver Water. And fortunately enough, things kind of transitioned where I got into banking. And
so that's a big jump from journalism to banking, right? Not what happens all the time, but exactly.
So worked for U.S. Bank, Wells Fargo, Chase Bank, Chase Home Mortgage actually for a little while. And that transitioned me into moving into insurance. So I was actually an insurance advisor with Liberty Mutual Insurance. Okay. So a lot of people have seen those.
Liberty, right?
And, after being with Liberty Mutual for 5 years, I knew all I could know, and I was still craving for more knowledge. And I had a young lady, which she was actually looking to retire within 3 years.
Okay.
And I helped her with her auto insurance, her homeowners insurance, explained to her why she needed an umbrella policy, which I'll discuss more in detail with you guys. But when we had the conversation about setting up a life insurance appointment, went had a good conversation, explained to her, how we were going to be able to transition an old policy into being able to make sure that she had good coverage, as well as making sure she had a policy that she was going to be able to use as a financial benefit. And so, sitting at her dining room table, she was like, Rashad, I've never had someone explain to me where I truly understand it like you have.
Mm-hmm. Oh, wow.
And so she went and she grabbed all her documents in regards to her investment accounts, and she laid it out before me. I reviewed it, and she said, I would love to see if there's something that you can help me in regards to doing.
Okay.
And so we ended up coming up with a plan, and we have wholesalers that we work with, just like financial advisors. And I called my wholesaler, and he's like, "Hey, Rashad, you actually have a great strategy to help her, but what's unfortunate is that you're not a financial advisor. You need to actually get her." And so that was kind of like icing on the cake for me. And I had one of my close friends that I actually had moved with a firm that I had conversations with. And so I called him and I said, "Hey, I know you moved over there and you're actually doing some recruiting now. So, why haven't you ever reached out to me?" And so he was like, "You've been on my radar, especially with your personality, how you're able to build relationships with clients and what have you." And so he ended up having me come in, and that's how I kind of transitioned into financial services. Make a long story short, once I actually got into financial services, I had a realtor and a lender that I have always had a relationship with when I was at Liberty Mutual, and they said no one knows insurance like you do, Rashad.
Okay.
And so they're asking me, they're like, we're sending you these clients, you're telling them exactly what to do and how to deal with these complex situations. What is happening, because you're just sending it to your old colleague. What is your old colleague sending back? And so I just told them, I said, I'm working on it, working on trying to get referrals. And so one of the real estate agents, she was like, I'm going to give you 6 months. In 6 months, if you're not, receiving any referrals, you're just basically doing free work. You need to step into that.
You need to get that, yeah.
And so after 6 months and praying on it, I decided to, since I already still have my insurance license, I started my own agency. And so I've been doing insurance on my own since 2017.
Okay.
I left Liberty Mutual in 2016, was working in financial services for a year, and then I added that to my practice.
Oh, that works.
And so, when I'm talking to a client, one of the things that we do, which is totally different, and the reason why even that lender and that real estate agent said, Rashad, you should get back in business, is because we talk about comprehensive planning. Right?
Okay.
And so with comprehensive planning, I'm looking at everything.
Okay.
And so with that, we want to know, how is money flowing in and out of a client's world?
We'll write some of this down just so I get it. Money
flowing. And when money is flowing in and out of your world, you want to know every dollar that's coming in and every dollar that's coming out. But, to really make it specific, we created what's called the 5 vital signs of financial planning. And so with the 5 vital signs, it's just like a doctor, right? If you were to call me and say, for instance, you were in the medical field, you were in the lending field, and you said, "Hey, Rashad, I have my podcast. We're talking about health." One of the things that we would talk about is vital signs of the body. We want to know, like, how's the heart rate? Is there a temperature? What is going on with that body before we start diagnosing or saying, "Hey, let's give medication for this." And so it's the same thing in regards to financial planning. And so the first vital sign that we look at in regards to financial planning is protection. Okay. And the reason why we start with protection is because we don't get a second opportunity when disaster strikes. Brian, disaster is not going to show up today and say, "Hey, tomorrow, make sure you're prepared, because I'm totally going to just come in your world and disrupt everything." It never happens. Yeah. Right. And so it's very important that we have these contracts in place to be able to make sure that we can mitigate risk. Okay. So we're not in a position where, if disaster does strike, now in regards to our balance sheet, we're using assets to try to cover that situation, or debt. Right? We might start going to the credit card because we don't have the assets available. Then it might be, we might not have the assets, we might not have the liabilities. And so we're going to our cash flow, right? And so we're taking that dollar that we were expecting to be covering a situation over here, Now we have to redirect it to cover this disaster over here, right? And so that's the reason why protection has to be first of mind, right? And so the first thing that I talk to my clients about is lawsuit protection, which is an umbrella. And so you can get an umbrella with your insurance carrier. It's usually, the one that you have your auto insurance with. There are some standalone companies that brokers have access to their own.
You have to go. We're recording right now. Go in the room. We'll erase that part.
No worries. So, the first thing that we look at is lawsuit protection. And so with lawsuit protection, it's an umbrella policy. You can get that with your insurance carrier. You do have to qualify through it. It's usually through your auto carriers. There are some companies that are standalone that offer umbrella policies on their own. But the reason why we want lawsuit protection in place is because if we exhaust the liability limits on our auto, or if we exhaust the liability limits on our home, once that is done, the insurance company says we're done, right? And so in order to qualify for it on your auto, you have to have at least a minimum of $250,000 per person, $500,000 per accident for bodily injury liability. And then for property damage liability, you have to have at least $100,000 on your auto. Right? So you can't just have state minimums. You have to have that to qualify for it. But the great thing about the lawsuit protection is if you do get in a car accident and if that person doesn't die, one, there's a running total. And so by having the umbrella, instead of you going out and hiring an attorney, hoping that that attorney can actually win that case for you and clear your name, one, if they're not able to do that, not only do you have to cover the retainer, but you also have to pay out whatever damages the judge says that you owe to that individual.
That makes sense.
But with the umbrella, what happens is now you have $1 billion insurance company that's providing you a policy at a minimum of $1 million, right? And so with them knowing that that $1 million is on the hook, they have teeth in the game just like you. So they're not looking to pay out their $1 million. So what they're going to do is they're going to afford their attorneys from $1 billion insurance company their time and resources to try to clear your name from that case. So you're basically paying pennies of the dollar to have large representation from a major insurance, $1 billion insurance company. And so the good thing about that is not only is the liability, if it's an auto accident, going to pay out, or if it's a liability on the home, going to pay out, but the umbrella is going to follow after. So the first thing is if they're able to clear your name, you get a chance to walk away. One thing you paid is the premium that you have in regards to that umbrella. Some umbrellas can go anywhere from $200. The max I've seen an umbrella is $800, just depending on what the client has, what types of risk or what type of claims that they've had in regards to like auto accidents, right? So that's the first one. The second one is health insurance. So I am licensed to sell health insurance. I don't sell health insurance, but health insurance is important, right? To be able to make sure that we have a contract that's going to be able to stand up for us in our deepest, darkest hour. So if we have to have a surgery, you want to be able to make sure that we have a contract that's going to be able to foot that bill so it's not falling on our balance. Right? And so, when I review that with clients, a lot of times with having the correct amount of savings, you might have the conversation with them. Hey, let's look at increasing that deductible on the health insurance, especially for someone that's young, healthy, and they have a good amount of liquidity. And the reason why we want to do that is because then we're in a position, just like with the auto insurance, if you have higher deductibles, less premium that you're paying out to that insurance company. That's more dollars that you get a chance to use, right? And it's the same thing in regards to buying that home. If you're able to build your savings, then it makes it a lot more accessible for you to be able to purchase that house. That's the reason why we say we don't want to put all our money to the insurance company. So we want to be proactive and come up with creative ideas to be able to make sure that we're keeping that money on our balance. Under health insurance, the third one under protection is disability insurance. So, one of the things I always ask my clients is, what do you think your greatest asset is? Brian, I'll ask you that question. What do you think your greatest asset is?
Me.
Exactly.
Absolutely. Because without me, it doesn't happen, right?
Exactly. It's your ability to be able to go forth and generate income. Right? And if you're not able to generate that income, one, you can't save.
Mm-hmm.
You can't take care of your lifestyle and all the things that you're responsible for, whether that's saving for retirement or paying off the debt that you currently have. And so the reason why we talk about disability insurance is because with disability insurance, most people have it through their employer, which is great, right?
Yeah.
But I ask my clients is if you got sick or hurt and you're used to 100% of your income, through that disability contract, because it is still a disability insurance policy that you obtain through your employer, with paying for it, you pay for it with pre-tax dollars. So my question is, if you knew that you got sick or hurt and you only had 50% of your income, could you actually survive?
Yeah, most people that live from paycheck to paycheck, or so people do, they can't survive.
Exactly.
Unless they have another 50% in savings that are sitting somewhere. And how do they save up for being able to get that? So that can be, it's super important to have something that says, okay, if I'm not able to produce myself and make the income that I'm making for my family, how would I do it? Because if you pass away, then you got the life insurance, right? Yep. But while you're still alive, which is a lot of people in these hospitals that are out here, right? They're alive. I had a cousin just recently who, he had some kind of skin thing that happened, and he was in the hospital for almost 8 weeks. And 8 weeks in the hospital, and his job's calling saying you got to come back to work. They're saying, I'm got to die, and they're talking about when you gonna come back to work.
Exactly.
That type of stuff. What takes care of him and pays his bills and his rent and all that kind of stuff.
Right. And that's the contract that actually pays it. Disability insurance, right?
Okay.
And so a lot of times when I sit down with clients, we're looking to supplement the disability insurance policy that they have at work.
Okay.
Right? So that way, instead of them now with disability insurance, just so you're aware, whether you have it through your employer or even if we're supplementing or adding something to it, the max that you can get is only up to 75% of your income. The reason why they won't go to 100% is because then you have no incentive to return back.
Gotcha. So you just I'll just hang out here as long as I can until it runs. Okay. But even said 75%, that could be a pretty big hit for somebody. I mean, it's way better than 50% or no percent, which I think is what a lot of folks have is no percent, because I think when I sign up for all my benefits at my job, that's not the one I'm not thinking that I'm going to need.
Exactly.
And so, you skip some of these things, and the older we get, the more important the insurances are.
Yep.
I know in my household how much we spend on insurances every single month, but it's an insurance that we can continue this lifestyle that we've created for us.
Right. And one thing that you said, and just to let the audience know, that disability policy isn't just for older people. The statistics actually show the actuaries are scientists that actually look and see, what is the chances that we're actually going to have to pay out on the claim, right? And so paying out on a claim for disability, the younger someone is, the more likelihood they have an opportunity that they're going to actually have a disability.
Okay,
right?
gotcha.
And so the older we get, then, we're moving towards mortality. And so that's where life insurance kind of plays in. And we want to be able to make sure that we structure contracts correctly there. But in regards to disability, we want to be able to make sure that we have a contract where we get sick or hurt, it's going to be able to pay our bills. It's going to be able to cover our lifestyle. And then there's also different riders in regards to disability insurance where they can also put money in away for you for retirement. And so, I sit down and I review that with my clients to be able to make sure, hey, if you, God forbid, you get in a bad car accident, you're not able to work the rest of your days. Like I had one attorney, he got a disability contract way before I got into the business, and he was making $1 million a year.
Oh, wow.
And if it wasn't for that disability contract, he would not be able to still pay the bills and also his employees compensation for his firm. And he told me, he's like, I was just happy that your colleague set this up for me, years ago, because if I didn't have it, I would be up a creek.
Yeah.
And so that's the reason why disability is important.
Okay.
The next one is, like you were talking about, life insurance. Right? Okay. And so life insurance is not just also about being able to make sure that we take care of those when we're gone, but it's also, especially when we're talking about home ownership, it's also a great savings vehicle. A lot of people in my demographic that we talk to that we're looking to try to bring in for financial services, they call it the account for the wealthy. And the reason why is because wealthy people know actually how to use it. And I'm talking about whole life insurance, right? There's other products. There's index universal lives and universal life products, but and I'm not going to go into all that, for time purposes. But you really want to have a clear understanding of what kind of contract that you're putting in place, right? Okay. But the reason why we talk about whole life in comparison to like the Dave Ramsey and Susie Ormans is because wealthy people really know how to use that account. Mm-hmm. And so what I try to do is bring that knowledge to my community where it's like, hey, you don't have to be wealthy to be able to participate in something that's going to be able to help you increase your wealth. Yeah. And the reason why we call it the account of the wealthy is because there's multiple benefits to a whole life insurance policy, right? One is it provides those legacy proceeds. So if someone passes away, to be able to make sure that that wealth is transferred to that family tax-free, because with life insurance, it is tax-free. The other benefit is you actually have a living benefit. Okay. So if you are trying to buy real estate or you're trying to buy your house, it's actually one of the greatest assets to be able to put your money. Okay. And the reason why is because one is guaranteed. Stocks, bonds, mutual funds, real estate, businesses, none of those are guaranteed, right? Just like in your industry, if the market crashes, the value of that home might be down. You saw that in 2008. Yeah. The difference with life insurance is the insurance company has to guarantee that that money is there. And the reason why is with the whole life contract, that cash value is chasing down that death benefit. So it has to endow at one point in time, and that time is at age 100. Right? Okay. And so the cash value, so say for instance, you started out with $1 million policy, and I'm just using this for an example, but if that death benefit grows to 10 million, the cash value also has to be at 10 million at age 100. Gotcha. And so the good thing about that is it gives clients the opportunity to be able to use that money for retirement. I help clients set up their own pension plan. We use a covered asset strategy or a volatility buffer, meaning if the market is down, instead of them pulling from their retirement account, now they can actually pull from the life. And we're not going to get all in that detail. But the main thing in regards to life insurance, and if you're interested, definitely give me a call. We can get more in depth in regards to how life insurance can be a benefit to you, not only just to be able to buy a house, but also in regards to retirement. Definitely give me a call at 303-941-3917. But the main thing in regards to life insurance, whether we have permanent life insurance, which is a whole life, we also want to be able to make sure that we protect the client's human life value. Okay. What I mean by that is if someone passes away, we want to be able to make sure that all the things that they were working for, I wanted to pay for my daughter's wedding, or I wanted to be able to make sure that, my son, in regards to his business, that I was an investor to be able to give him money to invest in his business. All those things are important, and that's real money, right? And so we want to be able to make sure that we protect that client's human life value. So if they pass away, that money that they were making with their job or with their business, it's replenished. It does not go away. Okay. Right? And so then the second vital sign, so we talked about protection. That's protection. Saving, right? Savings rate. To understand that you are the most important bill. It's not, even though, I know you work in the mortgage industry, it's not the mortgage, right? The mortgage is not the most important bill. It's not, being able to buy that Range Rover that you were talking about and drive around. It's being able to make sure that you pay yourself first. So the first thing that I always tell clients is something is better than nothing. If you're able to pay yourself 1%, that's better than zero, right? But the goal is we want to get to a point where we pay ourselves 15 to 20% of our gross salary. And like I said, the reason why is because we're the most important bill. But that's going to go into our third vital sign, which is savings level. And so that savings rate is going to help us build a savings level. The first thing that we want to do is we want to have 25% of our gross salary liquid. So that way, if emergencies happen, we know for at least 3 months we can take care of ourselves. Even with the disability contract. With disability insurance, most contracts, especially if you're getting it through your employer, there's a 90-day waiting period until that benefit will actually come into play. Okay. So 90 days, which is 3 months, by having 25%, you can at least cover your bills for at least 3 months until that contract kicks in place. But that's just the first step. And so we want to have 25% of our gross salary liquid, and we want to run towards that like we have gasoline draws on and fires chasing our tail.
I love it. Okay.
And the reason why is because it doesn't even have to be a disability, right?
No.
What if we step into our company and they say we're downsizing and today is your last day, right? If Jane has 25% of her gross salary liquid, she knows that she can take care of herself. And she doesn't have to go and fire sell her skill.
Yes.
Janet has to go and fire sell her skill. Meaning she has to go and find a job right away because what's going on next month? She might either have her mortgage or rent or whatever else, the other bills that she's responsible for. Those companies are not going to just say, hey, Janet, we don't care that you don't have the money. Right?
No, exactly. That's awesome.
They're going to say that. They're going to say, we don't care that you don't have the money. We need to get paid. So by having that 25%, it gives us the opportunity to be able to make sure that we take care of our financial responsibilities, right? Then we want to move towards having 50% of our gross salary liquid.
Okay.
And then 100%. So 50 to 100% of our gross salary liquid, which is 6 months to a full year, knowing that we can take care of it. But it's not just to be able to have that money for emergencies or what have you. It's also to be able to make decisions from a stance of power, right?
There you go.
And so what I tell my clients is, not to try to cut you out of the way, but what if, someone is selling their home because they just lost their husband, and and this really realistically happened to my dad's to one of my neighbors on my dad's block. And so one of the elders, she passed away. She left the property to her son, and that property at that time was probably $400,000 to $450,000. And unfortunately, a lady moved in next door. That's just to be honest, that was white, that didn't look like us in regards to the community. And she did some investigative work and found out that this young man owed some money, around $250,000 in debt. And she went to him. She had $250,000 liquid. And she said, hey, I'll give you this money. You sell me the house. That way you can go and take care of your debt.
Oh, wow.
And so she got that house at a discount.
Wow.
And that's happening all around the nation in regards to Black and brown communities, because there's individuals that know how money should flow in and out of their world, and they're able to buy these properties at a discount, not at the market value of what that property was, right? And so that's the reason why we say have 50 to 100%. And then you continue to build those assets.
Yeah.
But it not only just puts you in a position to be able to buy real estate, but it also puts you in a position where if you are in the market, right, stocks, bonds, mutual funds, you're not investing like with a gamble mentality. You're investing with surplus dollars. And that's the problem in regards to a lot of times the mentality of using stocks and bonds, where it's like, I'm going to put this $1,000 in the market, but I need that right away. And so when the market goes down, instead of that person buying more stock, right, they're actually selling and they're locking in those losses. You cannot return from those losses, right? No. And so by having surplus dollars, you actually invest with the right mentality. When the market is going down, you're not panicking. Yeah, because you're getting excited. Yeah, exactly. Yeah. Just like with real estate, on sale, right? Yeah. Everything is on sale, so you get a chance to buy more. So when the market recovers, you have more wealth. Your dollar is increased, and so that's the reason why with savings level we talk about. And then the next vital sign, which is the fourth one, is debt. We want to have zero short-term debt. We want to use debt to our advantage, right? Yeah. And so the reason why we say zero short-term debt is because, if you are using a credit card, you want to, one, use it for emergency. The other benefit is if you have like a mileage rewards card, in regards to travel, or cash rewards card, you want to go and buy that and know before interest actually hits that card that you're going to pay that credit card off. So that way, if, and I always use this as an example, I'm on my 6th laptop within the last 2 or 3 years. I actually bought 2 at the same time. But when I first bought my laptop, when I actually stepped into financial services, luckily enough, I didn't put on a credit card. I paid cash for it. And within a year and a half, that computer was basically obsolete.
Yeah,
It wasn't up with technology. I was looking for another laptop. And so if I would have bought that laptop on a credit card and then bought the new one also on a credit card, I would be still paying interest on it, because what happens with that? Most people just pay the minimum.
Mm-hmm. And 3 or 4 years, and
and they don't
still paying for something.
They're paying more than what the value of that computer is.
A lot, and the value of the computer goes down the second you get it. So you really pay that down.
Exactly. Absolutely. So being able to have that mentality of understanding zero short-term debt and to be able to use credit the way it was actually meant, meaning for emergencies, and if you are looking for those rewards, knowing, hey, before that interest hits, I'm paying that credit card off at the end of the month. Right?
Good advice, yes.
And then so with debt, there's things that, also kind of stepping into your space again in regards to mortgages. We tell our clients, we recommend a 30-year mortgage because the amortization schedule doesn't mean that you have to pay it off in 30 years. You can pay it off in 15, 11. You can pay it off at any time because there's no prepayment penalty. But the reason why we recommend a 30-year loan is because, one, if that person does qualify for more, say for instance they qualify for $600,000, right? And they're able to go and buy a property for $300,000. Their debt to income ratio, if they actually have a 15-year loan, is going to be a lot higher, right? Because on the 30-year, say for instance, it's $1,500 a month. I'm just going to use that as an example. And then on the 15-year, it's $3,000. You're paying more in regards to it. The lender, they don't care that you have it. They're just looking at your debt to income ratio, and they're saying, okay, well, you have a $3,000 mortgage, so you're paying more on that. But we're also looking at it, like I said, from a comprehensive lens. What if you get in the home and now the front is blown? They can't come back to you, Brian, and say, hey, I need that money. What can I do to get to that 30-year payment? They're going to have to refinance to try to get down to that payment. So why not just take the 30-year loan? So that way, if the furnace does blow, you can say, you know what? I was paying $3,000 towards my mortgage. Let me revert and let me just pay the $1,500 until I get back on my feet.
So when you start thinking about like generational wealth, and you start thinking about, I could spend $3,000 a month on one home, or I can spend $3,000 a month on two homes that has one that's bringing me income.
Exactly.
Now you start thinking about the future of your family and going, okay, where can I create income? Exactly. So if I have the goal is that I need to hurry up and pay my house off. And I say this because I do reverse mortgages all the time, and they say, well, we need to have mom's house paid off so we can get it when we're in. And I said, well, what if mom takes out that equity right now and gives it to grandkid 1, 2, and 3, and then they start creating income. Now that family has 4 houses instead of 1 house, and now they have that power that you were talking about to even do more things instead of sitting on a home that's got $700,000 of equity in it, that's doing nothing for anybody, but just sitting there. I mean, the peace of mind, I never have a payment, but at the same time, we're in this crisis now. We're in this crisis where there's not enough folks of color that own homes.
Exactly.
We need to get as many people in the homes as possible, and there's trillions of dollars of equity out there that can allow for this to start happening with the right protections. And you talk about the life insurance, and, as a generational wealth tool, not as not only replacing me, but possibly getting something else and more things that are available to somebody.
And one thing that you said, which is also part of the financial planning talk, right, is a reverse mortgage. So a lot of people don't understand that, you want to leave that legacy to your kids, especially in our communities, to be able to make sure that those properties are going to be transitioning down to the family, right? And so that's a play that, I work with clients. So a reverse mortgage isn't like what it used to be, right? So to be able to make sure that if there's a long-term care need, that elder can use their property. They built their wealth. They have that home to be able to take advantage of that wealth.
Absolutely.
And then once they use that wealth, if they do pass away, then the life insurance can basically pay off the home. And so that's the conversation. And that's the reason why these conversations are so important, because it's not just a one-stop situation, right? Every situation is different. And that's the reason why planning is so important.
Absolutely.
And so one of my favorite quotes that my mentor said, it's not that people plan to fail, it's that they fail to plan. And if you don't have a constructive plan, and if you're not having that conversation with an advisor or a financial service professional, then you're not prepared when life happens, right? And so by having that information and having that knowledge, you can use your assets in different ways. And so that's why it's important, right? And so that's the reason why we tell clients, look at the 30-year mortgage, because it's not just about getting into one home. If you can get, just like Brian said, get into multiple homes, then you're winning, because not only is that helping you in regards to today, but it's also helping you in regards to retirement. I kid you not. I have clients that they don't even want to get in stocks and bonds. I have one client, my best friend's mom, that only uses real estate. And so with real estate, you can use wealth, just like stocks and bonds. So in regards to that, one of the things that we also tell our clients, and it's hard in this day and age in regards to debt, is to try to at least be able to make sure that our mortgage payment is 15 to 20% of our gross income.
Okay.
And the reason why is because, just like I said earlier, that mortgage isn't the most important bill. You are. So we want to be able to make sure that, we're paying ourselves, we have the correct protection, but it's not even that, right? It's also in regards to lifestyle. What if, a lady comes to you and she says she wants to get in the home, but she also still wants to be able to take that trip with her girlfriends down to Essence Festival, to be able to still have lifestyle, where it's like, hey, yeah, I got out of the rent game, but now I have this high mortgage because I went with a 15-year, and I'm paying all my money towards the mortgage. No, let's not only be able to build wealth, but also let's focus on, being able to make sure that you get a chance to enjoy it.
Absolutely.
And so the last one, just, for time purposes, is budgeted lifestyle.
Okay.
The fifth vital sign. And so when we talk about budgeted lifestyle, is knowing every dollar that's coming in and every dollar that's going out. And it's not, where I sit down with a client, I say, I'm here to police you and tell you what to do with your money. But if hey, I like Starbucks coffee, and I'm going to Starbucks, and I'm spending $2,500 a year on coffee, that's great. But people that don't live on a budget lifestyle know every dollar that's coming in and every dollar that's going out. What if they find out, hey, I'm actually spending $5,000 a year on coffee? I'm not happy.
Yeah.
To be able to know that, so that way I can say, you know what, that additional $2,500 that I was sending to Starbucks to build their wealth, no, I'm going to take that back. I'm going to make sure my protection is up. I'm going to make sure I'm a world-class saver.
I love it. And I think when somebody comes to me and they talk about money, and well, money's not that important, or it's not that important, and like, what do you mean? Money's up there with oxygen.
It is.
It is something that it's how we transact our life, and it takes money to transact our lives. It's just part of the society that we live in and how we live. And if you don't know what those numbers are, like you said, $5,000 a year on coffee, that you say that as if it's like this big number, but I know people who spend $5,000 a month on coffee.
Exactly.
Starbucks or eating out. Eating out is a big one. We get these lifestyles that are microwave lifestyles. We eat out all the time, and then we start thinking, well, then you get to your end of your life, or you get to retirement years, and go, wait a minute, I don't have any money left, or you didn't take advantage of buying houses. I'm putting a lot of folks on the podcast that are young and buying houses that now have options. Before we end, because we only got a few more minutes, if somebody, we're talking about new home ownership here as we're going to have this Black House Wealthing Summit. When somebody's looking for insurance, for homeowners insurance, what are some of the, maybe the top three things to look at? Is it the cheapest price? Is it the amount of the dwelling? What are some things that somebody should consider? Because that's one of the things that we don't, even as a lender or as a real estate agent, I try to advise my folks, but that first thing, well, what insurance do I pick? Well, if you already have one, but if you're in a new situation, you've never had homeowners.
Yeah.
How do you figure that out?
So one of the things I always tell my clients is, one, you want to be able to make sure that you have the correct replacement cost in regards to the dwelling, right? Mm-hmm. And so a lot of people will say, well, the replacement cost also factors in, it does factor in your personal property, right? Mm-hmm. But the main thing in regards to that is going to be a percentage of what your dwelling coverage is. And so what I tell my clients is the first thing that you want to do, no matter what insurance agent that you're working with, is ask them for the reconstruction cost estimate.
Okay.
What is that reconstruction cost estimate? So that way you know, are they being honest and they're not pulling the wool over your eye? Because say, for instance, if you send it to an agent and that agent is shiesty and they want to make good premium off of that client because they get paid a percentage off of what you pay in regards to that premium, they might say, okay, well, I see that your loan is $640,000. I'm going to write the insurance for $640,000. But the problem is, once there's actually a claim, and say, for instance, there's a fire claim, and the adjuster comes out, and they're going to say it's not going to cost us $640,000 to rebuild this home. It's only going to cost us $340,000, right? So now you're in a situation you're paying more premium than what the insurance company is actually going to pay you to rebuild that property. So that's wasted wealth. That's the money that's going to the insurance company that you're not going to be able to recapture. So that's one thing. The other thing is, I always tell my clients is, minimum in regards to liability, you want minimum $500,000, especially in this market, right?
Okay.
If you're doing a loan for someone that's buying a house and that house is worth $640,000, and if they have a liability claim, whether it's at the property or outside of the property, and they have only $300,000 or $100,000, that's not even enough to be able to cover that asset right there, right? And so that's what that liability is, to be able to make sure that someone is not trying to go after your home. So I always tell my clients, and it's not that much more. We're going to review. Like, if we have to look at $300,000 just to be able to make sure that you get in the home, great. We'll look at that. But I'm not going to put you in a position where if something happens, you don't have a good contract that's going to stand up in your deepest, darkest hour. And then, one other factor is medical payment. We know, like, I can actually speak. I sprained my ankle in Mexico and I had to go to the hospital. The bill was like, $3,900 just with the tests and everything. I always try to make sure that I explain those things to my clients, because it's like, if someone got hurt at your home and if they're going to go to the emergency room, it's not going to be $1,000, right? And so some insurance agents, just by stepping your pinky toe in there, it's going to be $1,000.
Exactly. By looking at them, walking through the door.
There's some insurance agents that will just write it for, $1,000, and that's not enough. And so I always make sure that my clients have at least a minimum of $5,000 for medical. But, one of the things I would say is, really interview that person. The person that's going to take time, especially if it's someone that's buying a new home and has never done it before, if they actually take time with you and they explain those things, and, because one of the things I always tell my clients is, whether we're talking about financial services or even insurance, because insurance, you still have an advisor that's working with you. My job is to be able to make those recommendations. You're the boss. You're the CEO, right? If you're buying that house and you're coming to me for insurance, you're the CEO. Think of me as your external CFO. My job is to be able to make sure that you have the right things in place, so that way, that money's not coming off your balance.
Absolutely.
So I'm going to take the time to be able to explain. I'm not going to, I try to work on making sure I don't talk my client's ear off. But I am going to, at least explain how insurance works.
Rashad, I thank you for being on today. We are going to have the Blackwell Summit on the 23rd. Please be there from 5:30 to 7:30. It's at Cross Purpose. This conversation isn't over. We're going to redo this. We're going to come back. Hopefully we have a whole bunch of, clients that are saying, hey, what do I do next? How do I get insurance? So tell one more time how to get a hold of you, because insurance is important. It's not something we think about when we wake up in the morning. Can't wait to get more insurance. Or, you wake up, oh man, I'm thinking about my insurance. It's the last thing you want to think about until you need it. Then it's the first thing you're thinking about, why didn't I? And so the preparation and the planning that needs to go into it. So how do I get a hold of you again?
So Rashad Younger, my website is youngerenterpriseservices.com. And then you can also get me at 303-941-3917, which is my cell. You can email me at rashad@youngerenterprise.com. And I apologize. The website is youngerenterprise.com. The name of my company is Younger Enterprise Service. So,
all right. Well, thank you. We appreciate you being on another episode. You're going to make this. You have the ability to get a house. And if you haven't thought about it, right now is the time to start thinking about it. We have a team of people. We have a group of people in this community here, especially in the Denver area and all over the United States, of people who want you to have home ownership. So please inquire. We'll look forward to talking to you. Have a great, wonderful day. Well, thank you for tuning into our podcast today. It has been a fantastic opportunity for us to show you exactly what we're trying to do in the community. And that is to help people to make sure that they have the ability to realize home ownership. And so my name is Brian Arnold. I am a lender. I'm with City First Financial. And so if you have questions, I'm not doing this podcast so that we can, rush all the business over to City First Financial. I'm doing this podcast so that we can make sure that you are taken care of, that you have a real estate agent, that you have a loan officer, that you have a credit repair person, that you have an insurance person, that you have a financial advisor, all working with you towards making